Hello, welcome back to WINFXTRADING YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. In today's video, I'm gonna show you something great, new and interesting, something that is going to give you new experience in terms of capital growth as a Forex synthetic trader. This is a new asset that if you really understand it, you can take advantage because it has been launched newly. It is a newly launched asset. In other words, if you can stage for a long-term position, like you buy or you sell for long-term holding, you discover that you cannot see massive growth in your capital. So stay to the end of this video. Don't watch first few minutes or first 1 minute. No, watch to the end so that you can learn something great, something new, something powerful that will optimize your financial status. The title is DEX 900 Index Up/Down Explained, Deriv New Synthetic Indices. So in this video which I discuss, we shall be covering the following: general overview, comparing DEX with Boomcrash indices, comparing DEX with the Jump Indices, how lucrative is DEX. Before jump into the breaking down or detailed explanation of these contents, let's start with DEX. What is the meaning of DEX? Up till now, nobody actually understand the meaning of DEX. DEX does not mean decentralized exchange. No, that has to do with cryptocurrency technology. You use the word DEX in cryptocurrency world, but not in synthetic indices. Okay. The decentralized exchange is not for synthetic indices. In other words, when you hear DEX, it means derived indices or derived indices. Derived indices or derived indices. That's what it means. Okay. The X there means index. Okay. So now I'm going to start with the general overview of DEX 900 index. I think this will be much more easier to understand if we open one of the indices. Now this is DEX 900 down index. We have two types of DEX 900 index, one for down, the other for up. Now, what is the meaning of DEX 900 down index? What does it mean? It means small spikes and major drop every 15 minutes. So if you switch on your clock, if you have your watch, be looking on your watch every 15 minutes, come back to the chart and see if these properties keep reoccurring. What are the properties? Small spikes and major drops. So what is a spike? A spike means rise in price or bull event or bull candles. So all these white candles, that are bull candles or that are spikes. Wherever you see bull candle, it is a spike. Whether you see it in up or down, whether you see it in DEX 900 down or DEX 900 up, it means bull candles. Then the drops means bearish candle, that is the black candles. Okay, so if you look, this is 1 minute time frame, so you will see the series of spike or the bull candle and also some small drop inside. But our concern is measure. the measure, the word that connects with measure, which is the measure drops. So in this 900 die index, the key property of it is that a measure drops in every 15 minutes on average. So that is probability of seeing those drops. So the drop should be measured, should be large, should be long, should be the longest in the vicinity. In terms of dimension and size, it should be the longest in the vicinity. In other words, if you look at these candles, this one is the longest in the vicinity, so this is a drop. Okay, so if all drops are 0, assuming there is no drop, if there is no drop for all time in this index, whether up index or down index, if there is no drop for all time, what do you think will happen to the asset? Then the asset will be one-sided asset, which is impossible. No asset is one-sided, like one directional, because the spike are to be bull, like they are to be up, they are to rise. So if only spike exists, then it will move up, it will keep moving up to infinity without stopping. So if we are fortunate to see the price at 8,317, then maybe after 3 years it might hit, depending on the speed of movement, it might hit a kind of more than 100,000. Okay, let's assume that it become one directional asset, which is impossible. There's nothing like one directional asset in the whole world. But if it is possible, and if the pip is changing at a rate of, like, the speed of the movement is 100 pips per minute, okay, if we have 100 pips per minute, if we want to calculate like the price of this asset, or how many years it will take to hit a price of, let's assume, how many years will it take to hit a price of 100,000 if it is changing at a rate of 100 pips per minute? I don't want to be writing notes. These are simple analysis. Okay, so all you need to do is to calculate the displacement. Okay, I'm going to assume that the price is 8,000 now. Okay, so if you now have 100,000 minus 8,000, so the displacement or the change in pip is 92,000. Now if you have 92,000 as change in pip or the displacement, we are going to divide this 92,000 by 100,000. I'm sorry, by 100 pips per minute. So we are now having 920 minutes. Okay, 920 minutes. Now 920 minutes, converting 920 minutes to a year to years doesn't make sense, because it's not going to count to anything. But actually, we can convert 920 minutes to hours by dividing it by 60. So that is 15 hours. Okay, I want you to learn a lesson from this. Just learn a pure scientific lesson. Okay, it will only take 15 hours plus for the price of this asset to hit 100,000 if it only become unidirectional or single directional or one direction. Again, that is why all the financial assets are not single directional. Because if they are single directional, an informed trader who understood such direction will follow that direction and become extra multi super wealthy, I swear. As you see by the calculation, you can see it's real. Okay? In other words, the financial assets are designed to be energy conservative. They are designed to be energy conservative, meaning that it should have two directions. One should oppose one. One direction should oppose the other direction. So if price goes from A to B, there should be an event that will take price from B to A. In so doing, the total movement will be zero, and the process keep repeating. Even when it is not actually zero, it tends to approach zero. Okay, it tends to approach zero. Though most time there will be a kind of long-term unit direction in market movement, like long term, like in the long term. If you go to let's open this asset, for instance, volatility 200 index. In the long term, if you check higher time frame, you discover that the market must have made a bigger move to one direction. That is different from my perspective, like from what I'm saying. That is not what I mean. In the long run, like at infinity of time, price can actually maintain one direction like this, just like this one. But within non-infinity of time, like within certain times that are measurable, within short time, middle term period, you discover that price obey energy conservation. Okay, such energy conservation process will help to keep price within certain range and to control the level of wealth traders create. That's why you see a trader making it and the other one losing. And that one that is making it, if he's not careful, he'll be losing at a certain point, and the other one that is not making it will pick up. It's not that I'm saying that people, brokers design trading platform to actually wicked traders. No. The thing is that the system is designed in such a way that you are born we are born to make many errors, like to make many mistakes so that you lose. But only few will be able to succeed when they train themselves carefully, when they discipline themselves, and when they understand what the market is doing. Okay, or you can bypass all these failures or all these unknown by following an expert trader, like copying their trade in real time and trading along with them, so that you'll be among the few percent that are actually succeeding. Actually, the aim of WINFX trading is to optimize the number of winners in the Forex synthetic market to more than 50%. In other words, instead of having 1% to 5% or the 10% winners, we now have up to 50%. That is miraculous, and we are doing it. Like if you look at all my content, we are doing it. We're almost achieving it. Okay, check all my VIP members that are doing great. Imagine. Okay, let's continue. So markets are built based on energy conservation, though in the long run it tends to be one direction, but in the short term it is not one direction. Okay, now how do we bring this to DEX index? How do we explain DEX index with this idea of energy conservation? We are still on a down DEX index. You discover that at lower time frame, you can easily understand I come back here. you discover that at lower time frame, like M1, you will clearly understand what a down index is. That a down index, there's 900 down index, we have drops, major drop, which are bearish candle, very long bearish candle compared to any other candle. Okay, so all those big drop is what characterizes this 900 index. Okay, now if you now check higher time frame like H4, you will now discover that we still have those big candle that are called drop in a DEX 900 down index. So this is a drop, because if you compare it with any other candle, okay, you see that this is big. So this is the drop. Okay, now whatever I explained on DEX 900 down index applied to DEX 900 up index. The only difference is that for DEX 900 up index, you'll be considering major spike instead of major drop, major spikes. Okay, now both markets can create bull market or bear market. Like they can create downtrend, they can create uptrend. Okay, now there is something I said here that, like, if you look at the document, I say after the general overview, we'll talk about comparing this with boom and crash, and then comparing this with jump indices, and then why is it lucrative. Now I'm going to rush this because I don't want this video to take much time. Okay, now what exactly is the difference between this and boom and crash market? Okay, like what is the difference? If we open crash 1000, okay, this is 1 minute time frame. Okay, this is our DEX 900 index, and then this is crash 1000. Remember, in a crash market we also have this drop of a thing. Okay, now what is the difference? We need to understand this thing intuitively for we to go far here. Now if you check here, we also have drop in DEX 900 index, but then after if you check well, the way this is programmed is that more than one drop can occur in a series, which also happen in a crash market. Okay, now but the thing is, during the spike event, because in a crash market we have spike, but that spike is drop. Okay, so we have a spike or drop. Okay, now but then we have another event, which is a low speed price movement. Okay, in which the candles have the same dimension. Like those low speed candle, they have the same dimension. Like there are serial candle with low speed and they are directional, meaning that they just focus in that direction they are going. They produce candle of similar polarity. Like, look at what I mean. A crash market always produce bull candle of low speed, and they move in the same direction. They have the same sign. They are all bull candle. But suddenly, an opposite candle will create with high magnitude, with high length, with high size, with bigger dimension. Okay, that is what differentiates this from crash. A crash will have a drop just after a series of low speed equipolarized candle occur. Like those low speed candle that have the same polarity, they have to create for certain period of time, and then suddenly a drop in price or spike will happen. But when you come to this 900 index, the serial candles are not the same dimension. They have different dimension. The directional serial candle have different dimension, and most time the drop candles also exist, but like the opposite candle also exists or mix up with these ones. But in at intuitive level of cash market, there is no such mix. Those similar candles have to create in large quantity before a drop will happen. Only few period of time that it will miss with the drop. The serial candle will just miss with the drop, like here. It's rare. It's not. The frequency is reduced. Okay, so if you now check here, you will discover that there is a miss of, like, there is a kind of differences in dimensions and in frequency. That during the spike event, because this spike event have to happen for some time before a drop will start. During the spiking event, the spike have different sizes, and that sometimes miss with small drop. Have you seen it? Now if you look at it, you will now discover that this index is a very mysterious asset that can actually make you rich if you understand the mystery. Because if you look at the candlestick properties at higher time frame, like H1, you discover that this asset is always focused in any given direction. So if it is going up, it will have high speed in that up direction, and it will tend to align with a candle whose polarity matches that direction. Because if you talk up, then you are dealing with a bull candle, and you now discover that when it is going up like this, the spike event dominates, which is characterized by bull candle. Are you seeing it? Now, you won't take this type of characteristics or this type of behavior of asset for granted, because you should actually understand what this thing means. It means that there is no too much retracement. It will retrace small and then impulse more than that, like impulse infinity of time. In other words, once you predict the direction correct, you will make massive profit. It's not those type of profit you will see in boom and crash or other volatility indices whereby your asset will be in profit, after some time it will go to loss. It will be in profit. No, this is serious. This asset is focused. Very serious asset. I'm telling you the truth. It's like I'm taking much time to explain this, but there are more intuitive explanation of this. Intuitive way of approaching this asset, and there are also other hidden facts you don't know about this asset. Maybe if I have time, I might discuss them in upcoming videos. Even if you want to succeed in this asset, having the intuitive definition of the asset, which I have pinpoint here, you still need to learn the strategy, like how to trade this. You should understand the price action here. Okay, you should know how to enter the trade and exit the trade, how to put your how do you enter, what is your entry price, is that entry price going to be profitable or not, what is your stop loss, what is your take profit. Okay, see, all this, we are actually helping a lot of people change their life in VIP. We have started relaying signals on this index in the 𝒓𝒊𝒂𝒂𝒊𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂 we actually look into the problems traders are facing, and then we consider which asset are we going to be relaying at a particular point in time to speed up capital growth, to speed up the rate at which you make money in this game. Okay, I think this asset is gonna be crazy, in terms of making money. It's gonna make money crazy, like it's gonna make crazy money. I'm telling you the truth. Check this movement. It does not waste time. It's not something that will go down like this and then swishes. If you check jump indices is not serious and focused. Jump indices has a lot of energy conservation. I will explain energy conservation later. There are some assets that as it is flowing like this, then it will change and go up. And most likely, if you go up, it's going to break level, trigger your stop losses. So we should actually follow this asset squarely. Okay, so let me go back to document. We talk about comparing DEX with jump indices. Okay, if you check jump indices very well, you discover this property where, if you look at the higher time frame, I don't want to go into the basic definition of jump indices, but at least you know that there is probability of having 3 jumps every hour. Though jump means very lengthy candle, it could be a bullish candle, it could be a bearish candle. Okay, but if you look at jump market, intuitively, depending on the period of time, you discover that a jump market has energy conservation characteristics, just like other volatility or synthetic indices. Okay, you can see a market went up, it is going up like this, and suddenly retraces or just go to another direction. The energy content of this part, okay, the energy content of this part is being destroyed by energy content of this part. This means if you are making profit when you bought here, you are going to be losing when this market is approaching your entry here. Okay, then if you sold along this path, you are going to be losing when it is going up like this. So this energy conservation problem is very, very disadvantageous to trader, but very, very advantageous to brokers. Yes, because brokers want you to have a lot of depression. Yes, brokers want you to have fear so that you will be doing rubbish. Okay, but people like us, we are beyond those fear. It is fear that is afraid of us.